Welcome to this walkthrough of our IV Rush feature. We built this tool to solve a problem that comes up often in pre-earnings trading. You're looking to play the implied volatility rush heading into earnings. But what happens? Sometimes IV barely moves, theta eats into your position, and you're left with a loss. So we asked, can we model the IV rush ahead of time and help traders see if a straddle is actually worth entering based on projected IV behavior? That's exactly what this tool does. Let's take a look. Let's start with the main chart. In purple, we're showing the current at the money implied volatility. This is updated every 15 minutes, starting 5 trading days before the next earnings release. We refer to this as the pure IV. It's the IV of the straddle with strikes closest to the stock price at any point. This metric is the core driver of options value going into earnings, independent of skew or directional bets. In black, you see the historical median IV trend during the same 5-day window. This is calculated by tracking that same pure IV for previous earnings cycles, then computing the median percentage change from the start. This lets you compare the current setup to typical past behavior, helping you identify whether volatility is tracking above, below, or in line with previous earnings, and how it might evolve. To further understand these past trends, let's look at the table below. It shows the at-the-money implied volatility across past earnings cycles, broken down day by day, with values at both the open and close for each of the 5 trading days leading up to earnings. Take WFC as an example. The current IV sits around 37%, 3 days before the earnings release. When we began tracking 5 days out, it was roughly 38%. Historically, by this point in the pre-earnings cycle, IV tends to have increased by about 18% from its starting level. It typically reaches around 98% before earnings, nearly doubling over the 5-day span. So far, the current IV is closely tracking the historical median trend, remaining relatively flat. But if the past is any guide, the biggest spike often occurs on the final trading day before earnings. You might be wondering, where could IV go from here based on past behavior? That's precisely what we illustrate in the projection box above. It shows the current at the money IV, but also projects how high it's likely to go by the final session before earnings, based on those historical IV cycles. We basically use regression models to project where the current IV of the straddle is likely headed. For WFC, the current IV of 37%, corresponding to this straddle here, is projected to rise to 57% by the close of the last trading day before the release, which is July 16th in this case. Now we want to answer the big question. Will IV expansion likely beat theta decay? Or is the trade already priced in? Using our IV projections, we calculate the projected straddle prices both with and without that IV rush. The no-rush scenario just shows the theta decay you'd expect on the straddle by the last trading day before earnings. The rush scenario adds in the potential IV expansion to show whether that can offset, or fail to offset, that decay. This gives you a realistic estimate of your worst potential loss, in case there is no rush at all, and best potential reward in case the projection is confirmed. For WFC, the $81 strike straddle expiring July 18th, with an IV of 37%, is currently priced at $3.93. With a projected IV expanding to 57%, it's expected to rise to $4.11 by the close of the last trading day before earnings. However, in a worst-case scenario where IV fails to expand and theta decay takes full effect, the straddle's value could drop to $2.71. These projections are updated in real time to reflect how IV is actually evolving, giving you a dynamic view of potential outcomes. So far, the risk-reward profile for WFC doesn't look particularly compelling. But looking at historical patterns, the most pronounced spike in IV tends to happen on the final day before earnings. That might be a better entry point, and in this case, you can check back here closer to that date to see how IV has developed and whether the setup has improved. Obviously, this behavior varies by stock. For example, 4 days before earnings for ASML, even with projected IV expansion, theta decay dominates, and the straddle is expected to lose value. In contrast, at the time this video is recorded, a stock like Citigroup looks more promising with better upside. Altogether, this tool gives you a data-backed lens into how IV behaves before earnings, Go ahead and explore the tool. And don't hesitate to reach out if you have any questions.